It's 2023 and layoffs are here for the tech industry. In this episode of Biz Tech Explained, we're going to be dissecting the recent tech layoffs and breaking down why economic trends seem to be impacting the tech industry disproportionately. While I'm by no means an expert on the topic, I'm going to give my personal analysis on the topic as simple and as straightforward as I can. So we're going to be starting with the issue that pretty much everybody's aware of by now, inflation. So if we wind the clocks back to the horrible times of the pandemic, we can all recall as demand suddenly skyrocketed up as many people who met income barriers were able to get checks, which gave people more cash, and suddenly everybody was flush with cash to go out and buy things. Now, as we all are aware of very recently, this has made general items much more expensive. We know that the core CPI is actually up 5.7% as of December 2022, the 12 months trailing that. So what this essentially means is the Federal Reserve, those who are in charge of trying to lower inflation through their targeting tools, are faced with a difficult issue. And the tools that they used recently are to increase federal funds rates. So that essentially means to increase the interest rates, make things more expensive to try and drive down demand, which in turn is going to drive down inflation over time. Now, what has ended up happening is this has actually leaked into markets quite a bit. The reason why does that leak into markets? Well, it's actually, it's not quite simple, but it's an interesting topic. So the most common method of valuating stocks is known as the discounted cash flow model. And so a component of that is taking in interest rates, the federal funds rates, to be able to calculate what is the ideal value that a person should pay for this particular stock. So we have our analysts who calculate that and then publish the information, and then that gives us a good gauge of about how much is this stock worth. And so as we can very well recognize, as interest rates go up, that's going to affect the valuation of a stock, especially depending on what their balance sheet looks like. And so what has ended up happening is we've seen massive volatility in sectors that are a little bit more vulnerable to that model, hence major shakeups in tech, hence further layoffs. Next, we'll be breaking down a little bit further why on individual stocks. I chose the top four that have laid off the most, not necessarily the most amount of people, that have laid off a significant amount, and digging deeper into why they've made these decisions and sort of uncovering a little bit more about their internals. So we're going to be starting with one of the biggest of the major players announcing tech layoffs, Amazon. And we're going to be breaking down their returns, some of their metrics, and sort of why they've come to these decisions in light of the economic headwinds. So as I've charted above, a few important things to look at. Firstly, we see in the green, what's been charted is the annualized return on their stock, excluding dividends, since inception. So for Amazon, this is 1997. And the annualized return on that is going to be 30.76%. So if we look at that, that is really good. That's a really high return on an annualized basis. Since their inception, they've been growing exceptionally. They've made lots of good acquisitions. They're a dominant player, as all of us know. The blue line is also going to represent the annualized return on the S&P 500 over a set period of time. So that is going to be 7.3%. And then in the red we have is the year-over-year return on the stock price. So on Amazon, once again, excluding dividends and things like that. But the year-over-year return as of January 2023 from January 2022 is actually going to be a decrease of just under 49%. So major decreases, but especially a major decrease in Amazon. And then looking forward just past their returns on their prices relative to the bench line and relative to how they performed in the past, there's a few other important things that we can uncover. So their profit on a year-over-year basis from the third quarter is actually down 9% on the year. Cash for the third quarter ended is actually going to be up by 16.5%. And then the beta of Amazon is actually going to be 1.17%, or 1.17, excuse me. So the beta on a stock essentially measures how risky is this stock going to be relative to the rest of the broader market. So a beta of 1.17 tells us that Amazon is going to be risky or more volatile than the general S&P 500 or just the broader markets in general. So we can definitely see that reflected in its returns, right? S&P certainly hasn't returned negative 49%, whereas Amazon has. So a little bit more volatile. We can also see a hiring increase in 2021 if we look at the 10K from 2021 and compare it with the 10K for the year ending 2020. And we can see that a hiring increase of 310,000 global workers was actually added to Amazon. Now, it is important to remind ourselves that unlike some of the other companies, Microsoft, Google, and Meta, Amazon has a huge distribution and retail warehouse sector of their business. That's a huge part of their revenue. That's a huge part of their business model. So essentially what that's going to mean is the majority of those workers are going to be in that segment versus its corporate segments. So traditional operations or the AWS sector, which is known as sort of its tech hub. So that 310,000 is not comprised of a bunch of corporate and software engineers, product managers, things like that. But that is a significant increase. We can definitely estimate that a good portion some percentage of that amount is going to be in the tech sector. As we saw, about 18,000 people were actually laid off from the Amazon operations and tech side of things. Next up, we have Microsoft. So Microsoft's annualized return since were first publicly listed in 1986 is actually going to be 23.45%. So not quite as much as Amazon, but that's still a really good return. So they're definitely returning above the average annualized return to the broader market since they were first introduced. So really strong, high growth performing stock. We all know Microsoft products that perform well. Their year-over-year return, though, quite on the contrary, down negative 27.5%. So just in the same case of Amazon, things are not looking good there in terms of a stock price. So the revenue, so that is going to reflect that things are not going too hot, but that's mostly due to the economic headwinds. We can also see that their profit is down negative 14.38%. Again, that's based off the quarterly earnings for quarter 3 and comparing that to the quarterly earnings for quarter 3 from the previous year. So on a 12-month basis, their profit is down that much. Their current ratio is actually going to be their current ratio decreased by 15%. So what that essentially means, as we talked about previously, the current ratio is going to take the assets of the company and the liabilities of the company and see what shakes out. So it's going to say how much more assets do you have than liabilities. The reason this is important in looking at a stock or really looking at any type of company, whether it's public or private, it's going to tell us in that sort of rainy day scenario, do they have enough assets to cover those liabilities and current assets and their current liabilities. So their current ratio is currently at 1.8, which is still very good, but it did decrease a little bit. So that indicates that there's something going on with their cash. So it is 1.84, which is not a terrible thing. So it is 1.84, which is very good, but it could indicate that there are some things going on, given that we do have the 15% decrease in the current ratio. Could very well mean an increase in liabilities, which is likely happening there. The cash position, actually on a year-over-year basis, did increase by 19.4%. So that means cash is up. That is a really good thing for the discounted cash flow model, since we are ultimately utilizing the current cash flows and forecasting the future cash flows to arrive at our valuation, which is going to drive that stock price. Debt to equity ratio for Microsoft is actually even better. It's 0.26, so they have less debt relative to their total outstanding equity amongst the shareholders. And then Microsoft, interestingly enough, actually added 40,000 people in the year 2021. 18,000 of which are actually in the operations department, and that includes things like product support, it includes consulting. So that is a huge increase. Again, not nearly as much as Amazon, but Microsoft is much more tech-oriented. But 18,000 of those, like I said, came in the operations department. Moving on towards Google, we can see that their annualized return since they were first publicly listed in 2004 is going to be 20.59%. So again, not quite as much as Microsoft, but still very, very good. These are very good returns, being in the 20s, being above the broader markets. So we can definitely indicates that they've been doing things right. They've been innovating, as we very well know. They make fantastic products. Their year-over-year return, pretty steep, is actually negative 37.83%. So it's down quite a bit. Their profit is down on a year-over-year basis for the third quarter ending September 30th, 2022, just like we've been using as the benchmark for the others. Their profit is going to be down negative 26.54%, so almost 27%. Their profit is down. Their cash position is going to also be down negative 7.31%, which is also not great. Their beta is 1.07. So what that tells us is for Google, they're a little bit less volatile. They're close to 1, and being close to 1 essentially means that we're pretty well correlated with the broader market. We're about as volatile. So here, this indicates that Google is just a little bit more volatile than the broader market here. Looking at the hiring increase for Google, we can see that they added 21,199 people. Again, just like Microsoft, this is pretty much exclusive to workers in the tech field. They don't really run a strong retail sector, unlike Amazon, who added hundreds of thousands of employees, but still a significant increase in their hiring numbers. Moving on towards Meta, we can see their annualized return since they were first listed in 2012 was 14.06%. Once again, these are fantastic returns above that benchmark, as we're seeing in the graph above. Their year-over-year return was the worst amongst them, and there's been a lot of talk about Meta and their plans, from rebranding to new products, a lot of things, and ultimately it would appear in the graph above that shareholders did not like it, as they end up posting a year-over-year return from January of 2022 to January 2023 of negative 63.7%. So things are not looking fantastic for Meta stock right now, but they are a resilient company in a strong sector. Profit for them was down negative 52.2% on the year as they restructured their company and investments. Their cash was down only 1.3%, so negative 1.3. So that is interesting as well. Their current ratio is down negative 39.3%. Now, while that is a very big decrease on their current ratio, so either they are losing a lot of current assets. We know cash isn't one of them, since it only decreased a little bit. It could be some other things. But that likely means that their liabilities just increased by a lot. However, while it is a major decrease in the current ratio, they're still posting a current ratio of 2.57. So that is a very strong number. They have 2.57 as many current assets as they do of those liabilities. Their beta is 1.16, so they aren't quite the winners. Amazon takes the cake with a beta of 1.17, but Meta's beta is going to be 1.16, so it's still pretty volatile. And they posted a hiring increase of 13,366 individuals that they hired in the year 2021. And we can find that once again, as I mentioned, by looking at the 10Ks of the year 2021 and comparing it with that of 2020 under human capital. So now that we understand some of the basic financials that go into each of these 4 major companies who announced big layoffs in the tech sector, we can start to unpack a little bit more of why are these layoffs happening. Well, in short, most of the layoffs are happening in an attempt to appease investors by strengthening balance sheets. Now, while it's potentially not the best in the long run to lay off a bunch of employees, given that you will need those talented employees back at some time as things recover, but it is the fastest way. It is the fastest way to strengthen the balance sheets and try to increase those margins. Now, you may ask, why would it not be wise of these particular companies to go out and try and raise some debt to finance, to continue growth as they have been into projects that involve machine learning and generative AI, or even Web3, so things that have been really popular right now? Well, the reason being is, as we touched on at the very beginning of the video, that federal funds rate is the primary reason. So what that means is essentially debt is a lot more expensive than it was previously. So 2 to 3 years ago, when debt was at a very low interest rate, that was a very popular option. A lot of companies exercised that. But now that debt is much more expensive, it's not nearly as appealing because of the interest that's going to come along with it. So because those rates are extremely high for the time period, that likely won't be a plausible option for really any of the major players. And that's why we're seeing these budget cuts. So these particular products, these particular segments that we're seeing the major cuts in, these are the reasons. It is to strengthen the balance sheets as quickly as possible to appease these investors, to attempt to get these margins under control, really. As we can see, current ratio decreased from a range of about 12 to all the way up to, if I'm looking at this correctly, I am, 39% for some of these companies. So that means that things are changing in a way where the liabilities are increasing or the assets are going down. One or the other, but the fact of the matter is neither are good things for them, and they need to improve to be able to appease those investors to continue to fund their operations, or else they're going to continue to see stock prices go down and the total market cap of the company go down, which can lead to market share issues, losing market share, becoming less competitive. So it's a very complicated sector, but I hope in this video we were able to unpack and make a little bit more of sense. Once again, spotlighting some of the hiring numbers, some of the reasons why it wouldn't be feasible for a company to pursue other options such as debt financing right away. Again, layoffs are awful. This has been proven to not be the most effective way to deal with these sort of economic issues, but it is the fastest way to deal with them. As a result, families are impacted. There's significant consequences as such, but technology is a resilient sector. All of the talented individuals who have been laid off will surely find work and things will recover and with might.